What up, guys? It's August 8th, and I want to go today over Palantir, okay? I want to jump on the bandwagon and do a video just like everybody else on YouTube is doing, okay? Because I don't want to jump in there 2 weeks from now and everybody goes, oh, you're just jumping into everybody else and just talking about the same thing, okay? I want to give you my interpretation, good, bad, ugly, because it's definitely not a perfect quarter, but I think there's a lot to learn from a stock like Palantir and the kind of quarter that they just reported and the state that they're in as a business, okay? A lot to learn, especially if you're a new investor, okay? Before we get started, of course, please hit that like button, hit subscribe. Hopefully you learn something from these videos. We have some fun in the meantime. Let's get to it. So really quick refresher here. Palantir is a data mining, data interpretation, analytics company, okay? You're going to have artificial intelligence. You're going to have military products. You're going to have commercial center or private sector products for all kinds of applications. Here you can see the military. You can see assembly lines, laboratories, law firms. Ferrari, the Scuderia Ferrari uses Palantir software for their data interpretation in their Formula One vehicles. Okay, let me kind of show you that real quick. Here we have the Scuderia Ferrari Formula One team with the great Charles Leclerc, which is a great driver, and the not so great driver Carlos Sainz. I'm not a fan of Carlos Sainz. For all you guys Formula One fans out there, do not like Carlos Sainz. Probably should get a new driver there, but Leclerc is the truth. This is an amazing driver, okay? If you see the Ferrari vehicle, you'll see here, and it just kind of pop me out. Let me see. You can see right here in the Ferrari vehicle the Palantir logo right over here on the nose. Pretty cool to see during a race. Just a little side note right there. Now let's get to the money. Let's get to the business because that's what we're here to talk about, okay? So we got the Q2 2022 earnings. EPS miss, revenue very slight beat, and a really bad guidance miss, in my opinion, okay? So we start with EPS, loss of 1 penny versus 3 cents expected. So it was expected to be a profitable quarter, and nope, it's not. They lost a penny per share, okay? We'll talk about dilution of shares, which is something that's very important, which is helping cause this loss of 1 penny per share. Then slight beat on revenue, very slight. It might as well just been a meat of the revenue, very slight, very inconsequential, I think. And then the guidance was a really bad miss, I think. The 2022 outlook was decreased by about $8 million from 1.98 to 1.9, 1.902. Definitely not good to decrease guidance. Remember, we talked about this over and over again in these earnings reports. Guidance is the thing for Q2. Okay, this is what Wall Street is watching, is what is your guidance. You could have missed here, you could have missed here, but if you raised your guidance and said, hey, you know what, the worst is behind us, the stock probably would not have acted the way it did today, and we'll go over that as well, okay? The Q3 guide also down significantly versus the expectation, 506. So that's about what, 25, 30, 31 million dollars less than expected. That is a problem. That means that the business is expecting still ongoing slowdown of their revenues, okay? So quick look here at the action, okay? Today, so 14% to the downside today after reported earnings early in the morning today. The stock ended up after market 990, okay? After hours market, 982 is what it ended on the day, okay? But at the same time, this stock had already been demolished pretty heavily. I remember this stock being in the area of the mid-20s and everybody kind of loving this stock. A lot of Wall Street bets crowd, a lot of retail investor sort of hype behind the name, okay? But at the same time, I was never really involved in that hype because I just kind of rode the train, and I'm not thinking short term. I'm thinking long term. So I'm okay where I am. I'm down about maybe 4 or 5% on the stock at the moment. I need to be about maybe 15 to 20% down to keep adding to the position. Okay, so far in my position, about 900 shares at about 10.50 per share. I feel like if I'm getting into a pool that's really cold, I started kind of with my knees into the pool, then I got a little bit deeper, and now I'm kind of like waist deep and about to get into that whole, oh, it's cold, I'm gonna get a little bit deeper, like maybe to my chest, a little bit above my stomach. That's about how far in I am in my position. I'm pretty soon, if it gets below 8 or maybe around under the $9 mark, I'll probably just go full in and just dive and complete my position there and just hold for the long term and just hope for the best, okay? So here I put the price target. This is a Seeking Alpha average price target. 1190 is the average price target consensus for analysts on Wall Street, showing a high of 20. That's Raymond James that just did a high of 20. I think they're pretty alone up there, and then the rest of the analyst crowd is kind of lingering here in that $6 to $11 range. If you get anything under 9, I think it's a no-brainer to start a position. It's a no-brainer. I think it's a no-brainer now to start a position, to be honest, and it's been a no-brainer for the last 4 months, 3 to 4 months. It's been a no-brainer. So if you have a position of anything less than 15, I think you're fine, to be honest. And you should be adding selectively as you have money to really get exposed to when this company is already profitable in the future. Okay, now moving on. I really want to get into the nitty-gritty of the numbers here, because I think this is going to be extremely important to really dive into the numbers and go over absolutely everything. Because the numbers, these guys like to make the numbers look really good, because this is a high growth business. No matter how you look at it, it is high growth, but the growth is slowing, but the numbers are still quite impressive. So when you see revenue grew 26% year over year to 473 million, yeah, pretty impressive. But again, the guide was 30% from the prior quarters. And this is what Alex Karp, the CEO, had guided before, 30% CAGR until you reach 2025. That was the guide, not reach. This is 4% under the guide. So definitely they missed that guide altogether, okay? U.S. revenue grew 45% year over year. Amazing. Commercial revenue, 46% year over year. U.S. commercial revenue grew 120%. U.S. government revenue growth, 27%, right? So this is the slowdown right here. Commercial customer count increased 250% from 34 customers to 119 in Q2 2022. Amazing numbers, great. But that's not the whole story, right? This is not why we buy the stock. We don't just read the highlights and go, yeah, we're good, guys. That's good enough. That looks fantastic. We're buying the stock. We don't do that. We got to go a little bit deeper into it, okay? So we're looking here at the income statement for Q2, okay? And we're looking at several different things here. And for those that don't know or don't look at income statements, you're going to take a look at this income statement and you're going to split it right here down the middle. And you're going to either look at the 6 months ended, this is the first half of 2022, or you look at the 3 month ended, which is the quarter, which is the second quarter over here. For this purpose, we'll look at the 6 month ended. This is the first half of 2022. We see that revenue here increase from 716 million to 919 million. Okay, so that's good. That's a good thing. An increase in revenue of about what is that? Maybe 27%. That's what they're saying. 26%. That's what it is, right? And cost of revenue increasing slightly, not as much as the revenue, and the gross profit actually increasing nice and healthily from 551 to 722. So those numbers are good. And then we look at here the operating expenses, and we see that sales and marketing here going up. So spending more on sales and marketing. It's probably more sales than marketing. We know they have a sales team going on, and they're actively hiring people, while other companies are actually laying off people like Facebook or Microsoft, Google, where they're looking at layoffs. Palantir is looking at actually hiring people, increasing their workforce by about 25%, okay? There's a tick down here on R&D, research and development. I think I'd like to see a kind of constant in R&D. I don't see this as being too bad of a decrease. What is that? Maybe about 15% maybe? So it's a 15% decrease in R&D. General administrative, just a little bit tick down here as well. And overall, total operating expenses going from 812 to 803. Going down. Okay, so it's a good thing that revenues are going higher, expenses are going down. Okay, but we're still negative. But at the same time, how do we come up with these negative loss numbers, right? How do we come up with this? And the big problem that Palantir has had ever since essentially they started as a DPO is their total stock-based compensation, which you see right down here. Total stock-based compensation. But the good news on the stock-based compensation is that this number is going from this to this right here, 426 to 295. That is a significant decrease, on total stock-based compensation. That's what we need to happen. If you look at it on a quarterly basis, it looks even better here, 232 to 145. So we're going from spending almost $500 million to about 300,000 in the first half of 2022. I think that's a positive step, but we need that to ramp up in order to allow us to be more profitable. So the strategy for Palantir right now is, hey, we're growth first, profit last, essentially. We are growing the base of our business. So when we're profitable, that profit is so much bigger than what it would be with the current base of the business. Okay, if that doesn't make any sense, please ask me. Please let me know. Drop me a question below. Now we move on here. The balance sheet. This is a healthy balance sheet. I'm not going to go over it too much, but essentially it's a completely cash-free business. Cash and cash equivalents of almost $2.4 billion and no debt whatsoever on the liability side. I mean, you have your accounts payable and all kinds of things like that, but there's no long-term debt, short-term debt outlined here. So this is effectively a debt-free business. Now I want to move on to their actual earnings presentation, kind of break it down for you guys, kind of page by page, and kind of take it nice and slow, maybe not too slow, but go through each page and show you kind of what I'm looking at in these presentations and kind of what to not fall for, essentially, because I think there's some misleading stuff here that you don't want to fall for, and information that's right in your face that just looks pretty, makes it look good, that may not be so good. Okay, so here's the first page, here's the cover page, and then some disclaimers here, of course, and then the highlights. Revenue grew 473 million. Again, that's a slight beat. We talked about that already. Customer count increased to 304. Up from 169 a year ago. That's great. That's good. Okay, our business generated more than $1 billion in revenue on a 12-month basis. 42% growth over the prior 12 months trailing. Okay, that's excellent. Good. U.S. commercial revenue grew 100% year over year. Excellent. And then here they're telling us, hey, there's a bunch of stuff here that we do. Factories, laboratories, airplanes, evacuations, data centers. Good. Okay. Here's some other stuff about pharmaceuticals and biotech, whatever. TAM expansion. This is total addressable market. This is just fancy graphics to show you how much each of the software, what's the word I'm looking for? Platforms would actually give you. Okay. Now moving on, new products. Great. Fancy. Good. Okay. We don't care about that. Where's the money? Let's go here. Money. Some more graphics. Where's my money? Where's money? Show me the money. Financials. Here we go. Okay, so total U.S. revenue growth of 45%. Okay, so they're choosing to show you the U.S. revenue growth because the U.S. is stronger than Europe. It's stronger than any other country that we're selling to. So of course they're showing you that. Okay, and they're showing you kind of, hey, here's 12 months trailing, $1 billion generated in revenue, up 45% from Q2 21 and Q2 22 year over year. Okay, that's great. Not too crazy about that, but that's good. Okay, now total government revenue growth. Here is where we have a slowdown, right? So we have commercial and government. This is essentially Gotham, and this is Foundry. So 46% on Foundry. That's amazing growth. That means the private sector is eating up this software. This is a little bit of a double standard that the market has on Palantir, in which when Palantir became public, they kind of said, hey, we need you to stop doing these kind of elephant deals and do a little bit more gazelles and monkeys and smaller deals and diversify yourself more, so you're not so dependent on big contracts. That's exactly what they're doing here, guys. That's exactly what they're doing, but the market still punishes you no matter what, or finds a reason to punish you at the end of the day, right? So 13%, that's definitely a slowdown, but you have to think about the macroeconomics. What was happening in Q2? You have Ukraine, you have inflation, you have governments trying to tighten down spending so they don't aid the inflation problem. So of course they're going to be hesitant to spend money on products and on fancy products like software as a service type platforms. Now, moving on here, we're looking at net dollar retention. Okay, that's a good thing to talk about, net dollar retention. So this is the amount of money that existing customers are spending on Palantir. So this is the rate of expansion of existing customers, essentially. So when a customer gets acquired by Palantir, a lot of people forget that there's a phase for that customer to actually make money. There's an acquire phase, there's a sort of like a development phase, and there's a scale phase. The scale phase is where you make the money, where you make the big bucks on a customer. Okay, this has gone down. I think this was like 125. I think it was 125 before, and then it went down to 119. Not good for it to be going down, But here, it's not showing you this on this slide. It's showing you, hey, we still have great retention. Yeah, it's still a good number. It's gone down. It's weakness, but it's not extreme weakness, in my opinion. Moving on here, we're talking about our total customer count growth, 80%. Yeah, this is amazing. Customer count growth, definitely no critique here on customer count growth. Definitely going the right way, and it's still pretty strong with an expanding sales team. This should get even better, and hopefully the sales team does a lot better job because they're getting paid the big bucks. That stock-based compensation we talked about, that's for the sales guys mostly, okay? There's also engineers and stuff like that, but think about how hard it is to hire an engineer. You got to give them money to incentivize them somehow. I mean, this is a incredibly tight job market, so you got to give them money to come work for your business. You got to pay money for top talent. I think that's what Palantir is doing. Now, moving on. Commercial customer count, excellent here. Average revenue per top 20 customers. So this is what we're talking about when I said Palantir was citing up too many elephants and the critique of Wall Street. Too many elephants, not enough gazelles and monkeys. So this are the elephants. Top 20 customers are the elephants. And the average revenue per those is growing, okay? Not a bad thing that the revenue is growing, but it actually shows dependency on big animals versus small animals. So I think that we need to see some kind of tapering of this and seeing the smaller animals contribute more and add more of those. But again, remember, they need to go through the phases of acquiring, right? Acquire, develop, and scale. And that takes a little bit of time. So we'll give Palantir time to do that. Now moving on here, deals closed. That's good. Billings, that's good as well. That's fine. Don't care too much about that. Let's see here. We ended Q2 22 with $3.5 billion total revenue deal value, up 4% year over year. Fine. Revenue performance obligations grew 79% year over year to $1.2 billion. Excellent. Okay. Gross margins. Yep. You're a software company. You have high margins. We get it. Okay. Q2 operating income was $108 million, representing a margin of 23%. So see here, you see that they're telling you, hey, look, our margins are going down here. Our operating income margin is going down, but they're telling you, hey, we're continuing to invest in the business and position the company for customers to win. So they're telling you, hey, we're spending money on the business, we're growing it. Just chill out for a minute. Now moving on here, just free cash flow. Yeah, they're adjusted free cash flow, but excluding stock-based compensation. If that wasn't in there, then we'd be way positive on the adjusted on the free cash flow, even the GAAP free cash flow, in my opinion. Here's an interesting slide that I was looking here, and this is the commercial revenue growth year over year. Here you can see a little bit of what we're talking about. Is you see an increase, and then decline. That's what we're seeing here, okay? So that's something that the market doesn't want to see. They don't want to see that slowdown. They think that slowdown is a sign of weakness. So this needs to be maintained around maybe these two figures for the next couple of quarters. If we see a strong second half, I think these figures will be maintained or even better. If there's maybe some deals like they're telling us that are taking longer than others, maybe we'll see these numbers maintain or get even better, which is what we want to see. And on the government side, it's a little bit more ugly than that, right? We see 66 to 34 down. We just see a straight down trend on the government side. This needs to be reversed. But again, remember, we're seeing less and less government spending as the economy gets tighter due to inflation, supply chain, etc., right? Less spending overall, especially in Europe, guys. I mean, we see Q1 2022. This is where the Europe-Ukraine situation took hold here, right? From this point forward, that's when it took hold. So are European countries spending less on defense? Yes and no. I mean, there's some countries that say yes, but at the same time, I was kind of really disappointed by this number. I didn't like this number at all because you see pictures of Alex Karp meeting with the president of Ukraine, and there's a lot of hype behind that. And you think, why is he meeting there if he's not selling them something, or he's going to Germany and talking to NATO allies about software if he's not selling? But again, these are expensive products that require millions, if not billions of dollars of investment by these countries. So these deals probably take a lot longer than your normal kind of commercial deals, and that needs to develop. I'm not worried about a freeze or a very, very significant decline on the government side. I think the government side will still be healthy spending, but not as much as it was during 2021 when money was so plentiful, okay? So moving on, I want to go over the conference call highlights real quick and just kind of wrap this up. Okay, so the conference call highlights. My first opinion here with the bat is you got to stop the weird philosophical commentary. Alex Karp, and he's our CEO. He's very philosophical, kind of like a professor, like a college professor, and he's very smart. You can tell that things are going like a million miles through his mind at any time, and he kind of goes like this a lot. And I say keep Sankar instead. Sankar's a little bit more tempered in his talking. He's more focused on sort of like the grand scale of the software and how it's helping here and how we're utilizing here. Okay, even though I don't care too much for that, I think that Sankar is probably a better voice for the business than Alex Karp. I think Alex Karp is just better suited going and selling the software to somebody rather than just talking in a conference call. I'm kind of done with Alex Karp talking in conference calls. Okay, so the guide was reduced due to contract uncertainty. We talked about that. Ranting about how great your product is doesn't help the share price. So you can talk all day about how this product is differentiated. There's no competition. Snowflake is not a competitor. Microsoft is not a competitor. AWS is not a competitor. You can talk about it all day, but show me the money. Show me the money. It's not happening, guys. Okay. They acknowledge the difficult macro environment. Everybody's acknowledging that, so nothing new there. The strength of the dollar is a headwind. Okay, so the foreign exchange rate is causing revenues to decline up to 20%. And I think here, let me find it here, what he said exactly. I'm going to look at my other screen here to show you guys exactly what he said, because I thought it was very important talking about foreign exchange rates, okay, which are all out of whack because the dollar is so strong. Okay, so he says, obviously, it's not just that people are paying us in local currency. If you're paying us in dollars, which many of them are, you're de facto paying 20, sometimes more percent more that we can't capture in our balance sheet and we can't show to you. And he's talking about an income statement. Those things are impacting our business. I would say that the primary impact to our business, though, is actually positive. It's the U.S. adapting to things that are bad a lot faster, more quickly than Europe does, because Europe does not adapt to these things as quickly as the US does. So that's your spiel right there on the strength of the dollar. Now, when it comes to Sankar said something very interesting. We're seeing former customers, particularly those in the US, including some of the world's largest transportation, banking, and retail enterprises, return to our platforms in increasing numbers after periods of experimentation with other platforms and approaches. These customers are not returning to our software platforms merely because of the expansion of our sales, which does continue. They are often returning because they've tried other options, and those options have failed to deliver their needed results. That's good. I think that's very positive, and that means, yeah, the software is what it is, okay? Alex Karp said the sales in the U.S. commercial, which are by any standard unanimously strong, almost 80% growth this year without specs, totally organic revenue, being driven by 42 salespeople. 42. That's pretty impressive. 80% growth with 42 people. That's less than 1.5% of our company as a credit. We have more, but those are the ones that actually learned our product and are able to sell it. So 42 salespeople helped increase 80% of sales growth. Amazing. That's really good. And added 27 net new customers globally, reached $1 billion. We talked about that on a 12 trail month basis. And this was in a question and answer session. Profitability in business by 2025. Ouch. That's a lot longer than I thought, because we're so close to profitability. We're right there. But it's about growing the business first, not profitability. Profitability is probably the last thing on their mind right now. It's about growing the base of the business, then reaching profitability. They're telling us, hey guys, it's going to be about 2.5 years until that happens. That kind of sucks. Now, my overall opinion on the stock, I'll go over this real quick because I've already gone long enough, but you got to deliver more Wall Street friendly conference call, guys. Alex and Sankar and management team, just stop these fancy conference calls. I like that you went away from the video one that you did in Q1 and all the throwing out the F word and stuff like that. It's not professional. I like that you went to an audio sort of system, and I'm okay with that, but keep it more Wall Street, I think. Listen to other companies' conference calls and do that, okay? Execute sales, even in tough economic environments. Although folks tend to forget the phases of acquiring the customer. We talked about the acquire, develop, and scale phase. This is where you make money, okay? So a lot of businesses right now are probably in this acquire/develop phase, and they're still not in the scale phase. I think that we'll see that at a later time. It takes time for that to happen, okay? Stock-based compensation, they needs to keep dissipating at a higher rate and fast, okay? Stop diluting us. I'm okay with share dilution, okay? Especially if I'm investing into a good business with obvious growth. I don't think anybody can argue that Palantir has obvious growth and a great growth path, but stop diluting us into oblivion, okay? We look forward to second half 2022, which should be stronger on the government side. Keep the commercial side strong on growth, okay? Wall Street has all the double standards for the stock. We talked about those double standards before, okay? And watch the action on the strength of the dollar. If the strength of the dollar decreases, then this stock is going higher, okay? Not by a lot, but it's something that can be a catalyst for the stock to go higher. Also, the Fed rate action, selling at 13 times sales, that's not a cheap stock on a price to sales basis, but if the Fed pivots into a more dovish stance, this stock can go higher, okay? You got to keep a long-term outlook on the stock until 2025. If you're not here until profitability, then you're just a trader. Trade the stock all you want, okay? But I'm going to stay here for a while, okay? The 50-day moving average for you traders is about 940, 950. That's the 50-day moving average, not the 90 or the 80. That's the 50, okay? And this is the third straight quarter with sort of lackluster results. But the share price reflects that. We've been hit from the high 20s down all the way to like $6-7 a share. We've been hit. Okay, the stock is reflecting negative news, and it's already kind of swallowed a lot of bad news. Okay, and the strategy is one of growth and profit last. Okay, now that's it for today on Palantir. If you guys have any questions, please let me know. Like I said, this is one of my favorite stocks. Hit me up on Instagram, Twitter. Hit me up on the Discord chat. I'll leave the links below. Peace out, guys.